It's Monday once again, bringing the start of another trading week. Last week saw Draghi shake up the markets while China cut their interest rates. But what does this week have in store? Getting some insight into this week ahead, I'm joined by Craig Erlam, Senior Currency Analyst with Oanda. So Craig, in the US, investors will be paying close attention as the FOMC reveals its latest policy statement. While there are no expectations of any changes, do you think we'll see any significant movement in the markets?
I think we will. I guess the most important thing about this meeting is going to be the statement, which is released alongside. There's no press conference after, so we're going to get little real inside information that we normally get from these press conferences. But up until now, the Fed has remained on message that they are likely to raise interest rates this year. Now, this is the second to last meeting this year, which means that if they don't raise rates in October, then it's going to have to come in December if they do remain on message. And really, this is their last opportunity to either convince the markets, which are so far not convinced. Fed Fund futures pricing in more than 60% chance at this point that we won't see a rate hike this year. So really, this is the Fed's last opportunity to really convince the markets that rates are still on course to raise this year. If they drop this messaging from the statement, then it's very clear that they're not going to raise rates this year, and we're probably looking more towards the middle of next year. So really, it's a very important statement, and this is why I think you should have a press conference really after every meeting, because there's a lot of responsibility now on the Federal Reserve to convey a certain message within that statement so as to help the markets price in the eventual rate rise or no rate rise as it would otherwise stand. So with this statement being so important, then the markets are really going to be hanging on to every word in that statement, and when you get situations like this, that's when you tend to get so much volatility in the markets.
Both the US and the UK will see GDP growth rate data for Q3 this week. Some think UK growth will slip due to the weaker construction and manufacturing output, while after a disappointing labour market report released earlier this month, US GDP could guide the Fed away from a move in rates. What are your expectations in regards to this data?
Well, I think generally the markets are expecting a bit of a cooler period of growth in the third quarter. We have seen a lot of different figures actually point towards this, and we've also had things like the emerging market slowdown, which does have an impact on these economies. But I don't think the amount that it's going to cool is necessarily going to be as big as some people do fear. I still think 0.6% growth in the UK is a strong growth figure. Yes, the US is only expected to grow by 1.6% on an annualized basis. But we've seen these expectations missed before, and if we see a stronger growth figure than this, which I think it's more than capable of doing, then I don't see really any reason why they shouldn't really be looking to raise rates come December. The point that you made about the construction and manufacturing, yes, these sectors have experienced difficulties. Manufacturing sectors experience difficulties in a number of countries as a result of things like the emerging market slowdown. But I think it's important to remember that the services sector contributes around 2/3 or more than 2/3 to UK GDP. So while we do expect to see a slowdown in things like manufacturing and construction, they actually make up a very small amount of the economy, and therefore it's really the services sector which we want to be focused on. And so far the services sector's held up in the UK, and it's really been contributing quite well to growth over the past couple of years.
Now looking to Asia, Japan has a few important data releases this week, including inflation rate, unemployment rate, and the Bank of Japan's interest rate decision. Opinion seems divided on whether or not their central bank will boost monetary stimulus. Do you think the Bank of Japan will step up easing?
Well, I think further stimulus from the Bank of Japan is inevitable. It's all a case of when, I guess, and people are starting to price it in more for later on this year. So maybe as early as this week, and it is important because the inflation is still very low. We've seen 2 years now of monetary stimulus from the Bank of Japan, and really, the CPI inflation reading has still been far too low. They're nowhere near achieving the 2% target. So I do think stimulus is inevitable, but as it stands, I don't really think it's necessarily been conveyed to the market yet that it's coming very, very soon. So I think the Bank of Japan may actually hold off this week, but I do think some point towards the end of the year we may start to now see the message being conveyed through to the markets that more stimulus is coming, because they need to hit this inflation target, and so far, like I say, they're still some way off.
That was Craig Erlam from Awanda with me there. Now make sure you're keeping up to date with the latest news and market movements by clicking back to Dukascopy TV. Bye for now.